Welcome to the Fiscal Physical podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical podcast. My name is Aaron Hoisington, and I am joined, as always, by the founder of Alchemy Wealth Management, published author, Mr. Ryan Nelson. Ryan, how are you doing today, my man?
I am doing well. How are you doing?
I'm doing pretty solid. We want to make sure we shout out the listeners and everybody who's been tuning in here. Definitely find this podcast on pretty much wherever you get your podcasts, Spotify, Apple Podcasts, any of that. If you guys have any questions, comments, concerns, email us at podcast@alchemywealth.com with feedback. And I feel like so far, Ryan, I don't know if you can echo this, that I've been pretty happy with kind of the feedback and the engagement we've been getting from the listeners.
Yeah, 100%. It's been a lot of fun.
Yeah, it's been a good time just spending some time here with you, man, and also sharing this stuff with our listeners too. So let's go ahead and jump into this week's topic. Though we're going to talk about portfolio rebalancing is the one. So this is one of the things I was thinking about when we were getting ready to do this episode. Is one of the main philosophies I subscribe to just in life itself is balance. I mean, little of this, little of that.
Sure.
Like, make sure you, whether it be your diet, your activities, what you read, what you listen to, where you get your information from, balance is crucial. I always talk about that. So I'm like, all right, well, how does this apply to your financial portfolio? And when I saw this topic pop up, I was like, this is great. Let's have Ryan kind of give us some insight on how the idea of balance fits in here. So I'm going to let you go ahead and take it away, Ryan, and let us know what this means and how it can be applied.
Yeah, perfect. Sounds good. And yeah, like you were alluding to in the intro there, I think too much of anything is probably not good, right? Mm-hmm. And so the concept of portfolio rebalancing, I think, sort of implies that there is a balance. And what we mean by that is if we reference back to some of those previous episodes about asset allocation, mm-hmm. we can kind of think of that as being our balance. So if we were building a good financial plan, right, we'd figure out what our risk tolerance is, what our risk capacity is, what our goals are, and we would determine how much risk we should be taking in our portfolio, and therefore what our asset allocation should be. Mm-hmm. And so we may initially invest that way, and then, life happens, and next thing we know, we might look at our portfolio and we might be out of balance, right? Our asset mm-hmm. allocation might not be aligned exactly the way it was initially. And so rebalancing is really just working to get our portfolio back into that asset allocation that we determined was most appropriate for us to reach our goals. So a good example of this, it could be, if we thought of an asset allocation that would say 50% stock, 50% bonds. Mm-hmm. So half stock, half bonds makes this example really easy.
Easy math. We love it.
Yeah, exactly. And, let's say you had, let's say you had $100,000 invested. So there'd be $50,000 in stocks, $50,000 in bonds. Maybe it could be an awesome problem to have. Maybe stocks just start going crazy, mm-hmm. and your stock portion of the portfolio doubles. So you had $50,000 in stocks. Now that's grown to $100,000. Maybe that same time period, bonds really haven't done much. So your bonds just stayed where they are. So you now have $100,000 in stocks, $50,000 in bonds. So if you look at your portfolio as a whole, now you have $150,000. You originally were at 50-50, 50% stock, 50% bonds. Now you're at 66%, or 2/3, 100,000 out of 150,000. Mm-hmm. You're at 2/3 stock, and only 1/3, 50,000 out of 150,000 bonds. And so what that would mean is we're now taking more risk. We have more in stock than we had initially. We're taking more risk. And so it could be the results of a great problem. We made $50,000,
sure, yeah,
right, in stock gains. So a great problem to have, but nonetheless, we're now taking more risk, and that higher level of risk may not be appropriate with the goals we're trying to achieve. And so what we want to do is just rebalance. So in this case, if we wanted to be back at 50-50, 50% stock, we'd say, okay, we should have $75,000 stock, $75,000 bonds. In this example, we'd say, well, we have $100,000 of stock, so we have about $25,000 too much stock, mm-hmm. $25,000 too little bonds. And so so we would want to sell $25,000 of stock, buy $25,000 of bonds, and that is reallocating or rebalancing our portfolio back to those original asset allocation that we determined was the appropriate amount of risk for us to reach our goals. So in a nutshell, that's what rebalancing is. It's realigning our portfolio's risk to the most appropriate amount of risk for our portfolio. And that's an example where, again, great problem to have if the stocks go up. The inverse of that could be true, where stocks could have dropped and also put us out, right? There's lots of different things that could happen in our portfolio that could put us out of balance, but that's high level.
That's awesome, man. And being able to, with that comes the question of like, how often should this be done? Or does it depend on like the person, the clientele? Like, I mean, I'm not going to wake up one morning and be like, I'm feeling pretty out of balance with my financial profile. Like how does that kind of come about, and when do you really recommend doing that? Yeah,
it's a good question. One thing before maybe we move to that is I'll say not only would you want to be rebalancing your asset allocation, you might even more specifically want to be rebalancing your individual holdings.
Oh, okay.
So even somehow you might be in a spot where you're at 50% stock, 50% bonds, right? And maybe of those stocks, you own a couple of different companies, and company A takes off and you make a ton of money on company B or A, but company B drops a little. And so when you look at your portfolio as a whole, maybe you still have 50% in stock and 50% in bonds. But if you look at your stocks themselves, now maybe they're not allocated the way you want them to be, and you have way too much in any one company or one mutual fund or one ETF, right? So you'd want to look at this both high level and sort of drill down to individual holdings to see how the balance of everything is. But then, to your point, so you wake up, you say, am I out of balance today? Am I in balance?
I don't know.
Right? And so there's really no right answer to this. I think lots of different people might advocate for rebalancing sort of differently. There's a few, you could rebalance every day, every week, every month, every year, every decade, right? There'd be lots of different ways to do it. I would say if you're rebalancing every day, that might be too much. There might be costs associated with placing trades. There might be tax implications associated with placing trades. And so it might actually have a negative effect on your portfolio. The inverse of that is if you wait a decade to rebalance, that gives your portfolio a whole lot of time to get out of balance, and you might be sitting there for 9.5 years out of balance. And is that really is that appropriate, right?
Sure.
And so the two most common or popular time periods I see are both either quarterly or annual. Again, neither is necessarily better than the other. If you were rebalancing every quarter, just like systematically, it is possible that, let's say you bought something today, in a quarter from now you have to sell it. If it did great, you have to sell it. If you're do it like strictly rebalancing quarterly, the tax implications in one of our previous episodes, we talked about long-term capital gains. Oh, yeah. So you might be, if you're selling it a quarter later, you won't have held it for a year, so you won't be able to recognize long-term capital gains. You'd be recognizing what are called short-term capital gains and taxed at basically a less efficient rate. So you might say, well, gosh, I'd really like to just hold that for another 9 months. Sure. Yeah, I'm a little out of balance, but I'll take that trade-off of being out of balance for the positive tax implications, right? So there's not just like a set in stone amount of time you should wait. It's really going to be dependent sort of on your situation and comparing some of those other considerations. One thing I'll say though too is now with technology, I think a lot of times, like, I'll have clients ask me, they'll say like, so like, how often do you look at my portfolio?
Right. Definitely.
Right. Like, are you looking at my portfolio every day, every week, every quarter, every year? Like, are you just circling back to it once a year and looking at it and saying like, oh, does this need to be changed?
Sure.
And so,
it's a great question. That's really interesting. I didn't even think about that.
Yeah. Absolutely. It's a common question. Yeah, too. It's like, oh, are you looking at my portfolio like once a year, every 2 years? Like, and, the reality is probably back at some point in the past, that is probably how else would you manage somebody? You'd have to get physical eyes on their portfolio. So, it's like, how often, depending on how many clients I have, how often can you get through it, right? Nowadays, though, this is exactly what technology is good at, right? And so we can leverage technology for some of these things. And so oftentimes what we'll see is we'll set these effectively these benchmarks, and we say, okay, if your portfolio gets too far out of whack, either up or down, the technology will alert me, right?
Okay, gotcha.
So let's say I wanted you to have 10% in or whatever, 50% in stocks, let's say, and it got to 55% or dropped to 45%, then the technology could alert me and say, hey, time to look at Aaron's portfolio. It's a little bit out of balance, right? So that's a good way. Typically, we would call them like guardrails. So we could set guardrails up on your portfolio and have the technology trigger me. So if your portfolio moves from 50 to 51%, typically that's close enough to being in balance that's right where we want to be. It wouldn't make sense to go place a trade, potentially recognize tax implications, potentially incur trading costs. And so we could set some guardrails on both on the high end and the low end where the technology can trigger us. And what that might mean then is you might go like 5 years with never rebalancing.
Sure.
And then there might be a period of time where you rebalance 3 times in 3 weeks, right?
Right, totally.
So there's different, again, philosophies. Some people just take a strict time-based approach where it's like, I'm going to rebalance every 3 months, or I'm going to rebalance every 12 months. Or other people take like a guardrail-based approach where they say, I'm going to rebalance if I get plus or minus 5% or plus or minus 10%, right? So there's lots of different sort of philosophies around that and different pros and cons to both.
Yeah, no, that's a great way to paint that kind of picture too. And we've hit on it many a time on this podcast too. The personal finance is just that, personal, and being able to, work with your financial advisor to be like, hey, like is with the technology that's available, if you're like, hey, these are my goals, these are my, these are the guardrails that we've set, is
right.
Like recognizing when we might be getting over those guardrails.
Yep.
And like switching, course or rebalancing at that point is kind of where you want to make sure you're kind of staying in contact with that for sure. So, cool, man. Well, I think that really covers that topic really well and kind of paints a picture. Do you have anything else to add before we move on here?
I think that's a good high-level description of what rebalancing is. And so again, it's just really, it's getting back to that initial asset allocation. So again, in theory, rebalancing is meaningless unless you have that initial goal of what is it I'm trying to achieve? How much risk should I be taking to accomplish that goal? What should the sort of, I'll put in air quotes, ideal portfolio look like? And then you always have to acknowledge your portfolio is probably going to always be slightly out of balance, right? Just every single day, every single second, the stock market, bond market's changing, right? So you're never going to be perfectly aligned, but the question becomes, how much out of alignment are you comfortable with? And then at some point, you probably need to realign back or rebalance back to that original asset allocation. And so the act of rebalance or the act of realigning is what we call rebalancing. And really the question mark or the gray area there is at what frequency or trigger point do you use to say, okay, now it's time to rebalance.
Awesome. I love it, Ryan. Well, thank you so much for sharing with us there. And we'll be right back on the other side of this with some personal stuff. So hang tight.
And now, to put the personal in personal finance.
Welcome back, everybody, to this side of the Fiscal Physical podcast, where we're going to hop into some the personal section here. And this is one that I'm always interested with you, Ryan, because it feels like every time I turn around, you're doing something new. So, my question for you here and for the listeners to kind of delve into is, are there any new projects or goals you're currently working towards or trying to achieve at this point?
Yeah, I mean, nothing that's really huge on the horizon at this exact moment. I think from a business standpoint, just constantly evaluating different tools. At Alchemy Wealth right now, I'm evaluating like a planning tool. So a bit of work, time and energy goes into that. That's really behind the scenes, so nobody really ever sees the outcome of this. Yeah. But it does take a fair amount of work to like this. The evaluation of these tools is fairly cumbersome. So that's something we're working on. And then at the time of the publication of this podcast, I'm doing Ironman 70.3 in Oregon. So obviously just ramping up my training right now, and really focused on that. Outside of that race, though, I think kind of a goal for the remainder of the year is I'm focused on kind of maybe transitioning a little bit away from endurance and focusing a little more on strength training. Oh, cool. Yeah, that's kind of what's on my horizon. What about you?
Yeah, man. I mean, it's funny because I've been chomping at the bit to share this with you. I'm going back to school, actually.
Nice.
I'm going to get my MBA.
Oh, perfect. When do you start that?
July 1st is when it will be. So, at the point of this publication, I'll probably be knee deep in this at that
that's
point.
Awesome.
So, I am planning to go back and I'm debating on between my MBA or my Master's of Science in Business and Leadership.
Okay.
between the two of them, my company's going to cover a portion of it as well too. So just kind of I've submitted everything, and I'm honestly, I kind of credit this podcast for really kind of igniting that in me too. Is like,
nice.
I feel like I'm like, oh, cool, like this would be great to learn. Like, and you look at the course curriculum, and you're like, this is applicable in every part of like my life. So
yeah, that's awesome.
So yeah, so I'm that's in the works right now. So a few episodes I could just say like, actually I scrapped that. Yeah, if anything. So don't hold me to anything. But that's kind of the next goal for me here.
You going online or?
Yeah, gonna go online. Through I found a college that got a couple of my friends have gone through as well too. So it's a Western Governors University. So
perfect.
Going to get some experience there and see where it kind of takes me.
Heck yeah. Well, good. Congratulations. That's exciting. Do you know how long the program will be for you?
It should be a year to a year and a half. Perfect. Is what it should be. So it depends on how quickly. It's kind of work at your own pace a little bit too. Awesome. So depending on, it's not like I have a ton of free time in my life at this point, but it's kind of just maximizing that time and making sure that, that hour or so a night that I normally spend on watching a TV show or something, I kind of just put towards, school at that point.
Well, congrats. That's super exciting.
Yeah, I'll report back on this to see how it actually goes. But,
I love it.
I appreciate it, man. Appreciate the insight here, and I appreciate all the listeners checking us out here. Just a reminder that these episodes go live each Tuesday, so please check us out. Rate, subscribe, whatever it might be. Send us your feedback, and appreciate everybody for tuning in. And I'll turn it over to you, Ryan, to play us out here.
As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.